Hi, this is Brian Dolan with the law firm Pepper Hamilton. With President-elect Donald Trump taking office in a couple weeks, we thought it was a good time to discuss a topic that a lot of our clients have been calling us about since November 9th. What does a Donald Trump presidency mean for the financial services industry? Joining me today from Pepper's financial services practice are Pepper partners Rick Eckman and Greg Nowak, and special counsel Mark Dabertin. Gentlemen, welcome. Rick, let's start with you. Overall, what do you think the impact of a Trump presidency will have on our economy in general and specifically the financial services industry?
Well, thanks, Brian. I have been impressed with the picks that he has made so far in the sense that unlike the present administration, the Trump cabinet clearly has a decidedly business bent. I mean, if you look at the current cabinet, I don't know if any of them have any outside business experience, and most of them are policy types or have been in government most of their lives. So I think you're going to see a very, very different focus in this administration, which I think is going to be very positive for the economy in general and the financial services industry in particular. I think you're going to see them focus on cutting regulatory burdens and regulatory overload and the bureaucratic activism that we have seen, in this administration, the executive orders, when things couldn't get through Congress, they implemented things that attempted to achieve their goals from an administrative standpoint. So I don't think you're going to see that as much, if at all, in this administration. And I think their overall focus in terms of growing the economy, their whole theory on growing the economy is to help businesses, hire workers, be profitable, make money, and expand in the United States. And one of the easiest ways to do that, at least from their perspective, is to decrease the amount of regulatory burden that is placed on business. And I think that, Steve Mnuchin, who is the new Treasury Secretary designate, is a former banker. He has turned around IndyMac, which was a failing bank in California, and created One West, which has become a very successful bank that was acquired by CIT. And so he knows what the financial services industry faces. He had to deal with some very difficult collection issues, foreclosures. I mean, sort of the dark side, if you will, of the financial services industry in terms of having to kick people out of their houses. And so he knows what is involved in that. He knows the regulatory burdens that banks face. So I think that you're going to see a refreshing focus, if you will, on returning banks to their roots, which is, to help their local communities grow, their businesses located in their communities grow, and to make more credit available to more businesses so that they can hire more workers and really focus on that as one of the things that they're going to be doing.
Now, the incoming administration will have the opportunity to name a new comptroller of the currency, head of the FDIC, some of the FDIC directors, and members of the Federal Reserve Board. What type of person do you anticipate him naming, and what are the likely changes at those institutions going to be?
Well, he really is going to have the ability to remake really all of the federal banking agencies and put people that he thinks are going to drive them in a different direction, in my mind, than they have been. And if you look at the list, he's going to be in a position to immediately name 3 of the 7 Fed governors in 2017. In 2018, Chairman Yellen's term is over and the Vice Chairman's term is over, so he's going to, at that point, would have the ability to name 5 of the 7 members of the Fed. So you're going to see a dramatic change there. In terms of the OCC, the comptroller's term is over in March of 2017. Whether he stays on that long is unclear, but he would have the ability to nominate somebody to take over that role. FDIC, he will be able to replace 3 of the 5 board members, and in November of 2017, Marty Gruenberg's term as chairman will be expiring, so that he will be able to really put his own people there and change the direction, of that agency. On the FTC, I think there are four of the five commissioners would be able to be named. I think there are 2 vacancies today. So I suspect that he, if you look at what he's done to date, he has picked businessmen and people that have been successful in business and that know the industries, that they're where they made their money. So obviously Goldman Sachs has played a big role in terms of a couple of his picks to date. I would expect that you will see other businessmen or bankers, or that he will focus on those kinds of individuals, those with a business background, and not necessarily policy wonks, which is what you have seen more in the present administration. So remains to be seen. There's an awful lot of things that are going to have to happen, and we're certainly not that far down the list in terms of him focusing on these at this early date in the administration. But I think you're going to see a real sea change in terms of the kinds of people that he will nominate to run these various federal banking agencies.
Yeah, so it's Mark Dabertin. I'll add one point to that, and that's that you think about the changes that have occurred with respect to the OCC, for example, as a result of Dodd Frank Act. The OCC is really no longer engaged in consumer matters to the extent that they were prior to Dodd Frank. The focus of that agency now is primarily on safety and soundness. And so to Rick's point about choosing folks with a business background, I expect that they would choose individuals who are the most suitable for the current mission of those agencies, which in some cases, like the OCC, has changed over the last decade.
Now, one of the cabinet nominations that President Trump has announced is Senator Sessions to be Attorney General. What changes, Rick, do you anticipate at the DOJ as they relate to the financial services industry?
Well, as we have seen with the current administration, there has been a real focus on the financial services industry by the Department of Justice. They've gone after companies involved in the mortgage meltdown. There have been huge civil penalties that have been assessed, and there was a real focus on the Operation Choke Point on ways to get at certain industries that this administration, or at least the Department of Justice, felt were ones that needed to be curtailed. I don't think that you're going to see that continue in a Trump administration Department of Justice. I think it will be returned to its roots, if you will, of fighting, fraud and criminal conduct, and that they will not be in a mood to continue criminalizing, conduct which, in the past, was never viewed as such. Particularly when it came to, those operating in the financial service industry. So it'll be interesting to see what changes are made. There's going to be a whole new set of U.S. attorneys out there. They're still going to, there's still going to be prosecutions. There's no doubt about that. But I think that things like Operation Choke Point, where you had the Department of Justice going after payment processors who were processing certain types of transactions with the express goal, clearly, of putting those businesses out of business. And that continues today with the whole effort to, I think they call it discontinuance today, with respect to the banking agencies, the de-risking, focus that companies, rather than beef up their compliance activities in certain areas, are basically getting out of servicing certain kinds of businesses because of the concern that the Department of Justice and perhaps even the CFPB will, go after them because they're somehow participating in what they view as fraudulent conduct, or a conduct that, is against certain consumers' interests. So I think you're going to see a different focus under this new administration, and that it, in my mind, for our client base, will be a welcome change.
Greg, do you see a return of Glass Steagall?
Well, that's an interesting question, Brian. I guess it's useful to remind people what Glass Steagall was and what it accomplished when it was in force. You have to go back to the Depression and the fact that banks were all undermined with bad loans. The Franklin Roosevelt 100-day closure of banks in order to allow them to get their houses in order, et cetera, at the beginning of the Great Depression. But one of the root causes that was identified at the time was that banks were using deposits to invest in securities, in the stock market, the bond market, et cetera. And so the Glass-Steagall Act created a wall. It separated investment banking from traditional banking. And the theory being that investment banks, especially those engaged in proprietary trading, should not be able to avoid the risks associated with their investments by having a backstop of the Federal Treasury through the FDIC or other insurance programs that were created at the time. So for many, many, many years, Glass-Steagall was in place, but it slowly was eroded with changes to the banking laws that allowed banks to create holding companies, and then out of holding companies to create brother-sister entities that engaged in underwriting and brokerage activities traditionally relegated to the investment banks. So finally, it was decided that Glass-Steagall was an anachronism and was no longer needed. On the campaign trail, both Trump and Clinton championed a return to Glass-Steagall, reimposing the ban between investment banking and traditional banking. If we're to believe the candidates, this would be high on their agenda as a way to reestablish the separation and make sure that too big to fail no longer affects the U.S. taxpayer in the way it did before. Personally, I think that's somewhat of a sledgehammer approach to a perceived problem. I do think that the Volcker Rule is a form of a Glass-Steagall, because the Volcker Rule, which came in as part of the Dodd Frank Act in 2010, mandated that banks could not engage in proprietary trading, and as a result, most of the large banks had closed down their proprietary trading desks, had spun them off. Dodd Frank limited the amount that banks could invest in hedge funds if they were the sponsors or other originators, and other types of investment funds. And so, as a result, we've had a de facto form of Glass-Steagall in place without the actual separation of the investment banking and brokerage functions from traditional deposit banking. But the reason why I said it's somewhat of an illusory response is, if you think about how banks make money if they're not engaged in this type of trading, they make money by making loans. Well, if they make a loan to a company that's heavily engaged in proprietary trading, then their risk of repayment is essentially the same as if they'd engaged in the proprietary trading itself. And so that means the bank needs different underwriting standards and credit standards. And in effect, it's acting as if it were a proprietary trader, but it's doing it one step removed. Will that stop banks from having the same systemic risk introduced to them associated with securities trading? I don't know, and I think that's anyone's guess. So I do think you will see at least President-elect Trump taking his campaign promise, at least considering it. I don't think he'll back off of that altogether. But whether or not we get a complete return to Glass-Steagall in its Depression-era glory, I don't think we'll see that. But we will see some form of that. There's already been talk, of course, about relaxing the Volcker Rule, because in one man's or one woman's perception of proprietary trading is another person's market-making activity, is another person's swap counterparty activity. And everyone says, oh, no, we weren't trying to stop that. But where does market making stop and proprietary trading begin? And where does being a swap counterparty to an energy swap stop being essentially a market making function or a money making function and turn into a proprietary trading function? I guess if you're acting like a true broker and you lay off the risk, in a swap transaction to another counterparty, and you're simply acting as the middleman in the middle, then you haven't taken on any systemic risk. Well, the dirty little secret is most Wall Street banks have always run their prop trading books essentially at a net zero, and it's only when they get stuck in a short squeeze or when the music stops and people get out of their positions too quickly and they can't grab collateral that they've had an exposure. And those are truly, black swan type of events. But, I'd like to ask my colleague Rick Eckman what your thoughts are. You're coming from a banking perspective. Do you think we'll see a return to Glass Steagall?
I would find that highly unlikely. I think that, there is a bigger issue here, which is, the too big to fail issue. And I think if you look at Hensarling's Choice Act, he presents an interesting, different kind of way, to basically decrease the regulatory burdens which are placed on banks, but at the same time increase the amount of capital that they're required to hold to make it less likely that they would fail. So I think going back to Glass Steagall pre-1999, I think is highly unlikely. The banking industry was extraordinarily good at figuring out ways around it, in conjunction, quite frankly, with a lot of the banking agencies, particularly the Fed. So I think it's a difficult issue. I certainly think, though, that we could see a simplifying, if you will, of the Volcker Rule, which you already saw the Fed recently gave banks, I guess, could apply for a 5-year extension to unwind, their current position. So I think you're going to see a lot of, focus on this, but I would not expect the Glass Steagall Act to, come back in the form that it was in 1999 before it was abolished.
Yeah, I agree with that 100%. It would be very difficult to turn back the clock to pre-1999. Especially, as you said, the way the regulators had been slowly but surely eroding its efficacy with different workarounds that they had approved for banks through brother-sister entities or otherwise to get involved in proprietary trading. So, and remember, proprietary trading does provide a very valuable function in our financial system. It's important that that companies that need liquidity can get liquidity without having to resort to the Fed deposit, the Fed discount window. And if you don't have certain pools of money like banks being able to play in that space, then sources of liquidity dry up. And sooner or later it becomes a problem for the economy on a larger basis.
Yeah, and one of the argument, which I really haven't heard made recently, but one of the primary arguments to abolishing Glass Steagall is that, it allowed our banks in the United States to be competitive on a worldwide basis. I mean, banks in other countries, had the ability to do all kinds of trading that we did not, and that was creating inefficiencies in a sort of uneven playing field. Now, whether that argument continues today would be, an interesting subject to look into. But I think that's still an important function of our government, is to make sure that our banks operate in a safe and sound manner. But more importantly, or at least as importantly, are competitive on a worldwide basis.
And what I'll add to the discussion is, first of all, we're not that far removed from the second largest downturn in economic downturn in U.S. history. So I do not believe that you're going to see a market easing of restrictions on proprietary trading. I agree with Greg that the Volcker Rule is really, you can view it as a further refinement of Glass Steagall. And with respect to the Volcker Rule, what I think you're more likely to see are things like clarifications. To Greg's point earlier, there's a fine line between what might constitute, proprietary trading, market making, hedging activities, I think what you'll see is further clarification, things like what constitutes a trading account, and an easing to the extent that the rules become more manageable, more understandable, but not a fundamental reversal of the restrictions that are in place. Along those lines, I read recently that in order to dramatically change the investment limitations that were imposed by Dodd Frank Act, you need a 60-member Senate majority, and I don't think you're going to see that again this close still to the second largest economic downturn in U.S. history.
Well, that's an interesting point. The rules of the Senate still allow for unlimited debate, essentially filibuster, in all circumstances except budget reconciliation. So in order for them to use just a simple majority to accomplish this, they would have to go back to the full Senate, and unless they can somehow get it under reconciliation, and the likelihood is that won't happen, and so it's doubtful, unless there is a very robust replacement, that the Senate is going to adopt a rule that would roll back the clock in that way.
Now, Greg, what do you see for the future of Dodd Frank?
Wow, that's an interesting question. The Dodd Frank Act was a massive retooling of the American financial regulatory landscape. It affects banks, brokerage firms, investment advisors, private funds, private equity funds, hedge funds, registered mutual funds. So the entire landscape got an examination, and things that previously were not considered to be systemic risk all of a sudden were under the microscope as the government attempted to try to ring, or at least identify, systemic risk in the system. They couldn't wring it all out, but they certainly have tried. If we break it up into segments, let's look at the fund world first. I think one of the things that Dodd-Frank did was require the registration of investment advisors for all types of funds, with some very limited exceptions. It also was an unfunded mandate to the states. By raising the de minimis amount for federal regulation, it essentially put the burden for review of fund managers and funds that were below certain thresholds back on the states. The states weren't prepared for that. Most of them had shut down their compliance programs and enforcement divisions and dramatically cut them back after NISMIA back in the 1990s had shifted most of the burden for this to the feds. So there were two things that happened with regard to funds and advisors in Dodd-Frank. The first was a larger number of advisors were brought within the ambit of regulation, and then secondly, a bright line was drawn between those that were regulated by the states and those that were regulated by the feds. I don't think that line is going to move in any way in particular. Perhaps the de minimis amounts will be raised a little bit to shield smaller advisory firms from the scrutiny of the feds. But that just means that they're stuck with state regulation. And if you've ever dealt with trying to get a state regulator to approve an investment advisor under the thresholds, it is a bear. They don't understand the rules in the main, and you're constantly educating them as to how advisors work and what they mean. Now, that will change once they tool up, but they're still expending funds that they didn't previously expend. So I don't think you'll see much tinkering there. I think the industry has, for the most part, learned how to live with the advisor registration rules and the custody rules and the accounting rules. And so I don't think you're going to see any great groundswell to repeal that, except in one area, and that area is in startups. You still have people who want to live the American dream and start their advisory firm and start a small hedge fund and let it grow and see where it goes. Now, the cost of doing that between the fund documents and then getting your registration materials together for your advisor is not inexpensive, and so the barrier to entry has gone up. If we think there's going to be any change on that side, that's where I think you might see it. In terms of brokerage, Dodd-Frank primarily affected the brokerage firms that were owned by the large banks, and they're affected primarily with the Volcker rule and the push-out rules. And I do think that there you will see scrutiny because the banks don't want to lose a very lucrative business that they've had. And I do think that in terms of some of the other things that we've seen out of Dodd Frank, the CFPB, and for that one I'm going to defer to Rick. I know he's made a small career out of dealing with the CFPB and probably has some very strong opinions on that one. Rick?
Well, it is a fascinating time right now, and that is primarily because there is a case which has been well reported on called PHH, the CFPB, and the PHH case was heard in front of the D.C. Circuit Court of Appeals, and it was basically a appeal for an administrative ruling from the CFPB, where, Director Corddry himself imposed I think it was a $109 million fine against PHH, which was sort of a tenfold increase from what the administrative law judge had imposed. But the interesting thing about the case was that what PHH appealed it to the circuit court, and the circuit court, in a blistering opinion, found in favor of PHH both on the RESPA count, but more importantly, they found that the structure of the CFPB was unconstitutional. It was unconstitutional because of the fact that Director Corddry is a sole director, and that he needs to be, with all the powers that he is given, the court found that he was essentially had as much power as the President of the United States, and therefore the President needed the power to be able to fire him at will and not with cause, which is what the statute provided for. So that case is currently, there's been a motion to hear that case en banc in front of the entire D.C. Circuit Court of Appeals. But, so you have that as a backdrop, and then we had the election, and which surprised a lot of people, and you have President Trump taking office on January 20th. Now, importantly, even though the court found that restriction on the ability of the President to fire without cause was stayed as a result of the motion en banc, the thinking that I have heard and read about, and I think will happen, is that the President, on his own accord, if he gets an opinion from his counsel, the White House counsel's office, saying that that structure is a violation of the presidential prerogative to hire and fire people that work for him, that he, day one, will fire Director Corddry if he does not resign. And so I think you're going to see that happen. I would be surprised if it didn't happen. And then, there's a whole chain of events that will have to occur, including, I guess the deputy, David Silverman, would be the acting director, without portfolio, of course. And then the president's going to nominate somebody new. And if you recall, there was a lot of controversy about Richard Corddry's appointment, and sort of the net result of that is that Harry Reid invoked the nuclear option, as I recall, and as a result, the Senate only has to approve any appointment that's any nominee, including cabinet nominees, which are going to be coming up shortly, to a simple majority in the Senate, and it's not subject to the filibuster rule. But clearly you're going to see somebody who is certainly more conservative than Director Corddry was, who's less of an activist, who is more as a businessman, who is going to be finding ways to promote, credit being granted to consumers in this country, as opposed to ways to basically restrict it and allocate credit to, away from certain parts of the population, those such as Senator Corddry view shouldn't get the credit, or they shouldn't get it at the price that folks want to lend it out at. So I think there's going to be big changes at the CFPB. And that's probably worth talking about in a separate podcast at some point.
Hey, Rick, here's a good question for you on the hypothetical. What happens if the president does get that memorandum, fires Cordray, and Cordray refuses to leave on the grounds that he disagrees with the president's counsel?
Well, I think the remedy is that he can sue the federal government for back pay, and that there's a case called Humphrey, which was decided, I guess, in the 30s when President Roosevelt fired an appointee, and I do not think that a court is going to stay the president's decision. I don't think they have the right to do that. I think his remedy is limited to a action for back pay. And whether
he can't stay, he has to go.
He can't stay, he has to go, and if he doesn't leave his office, they will send federal marshals to escort him out.
One thing I'll mention with the CFPB is the power that the director wields. So a change in director could have a very significant impact on the CFPB. When you think about, some of the actions that Director Cordray has taken that were lightning rod for criticism, most of them really, in my mind, focused in on the powerful discretion that he had available. For example, the abusive standard under Section 1031 of Dodd Frank, huge criticism that the CFPB has never issued regulations that they've really approached, what constitutes an abusive act or practice based on this, idea, you know it when you see it. Well, a different director may not see it unless it's directly in front of their nose. And so I think that's a very important thing to recognize, the extent of the authority that they have. I'll give you another example quickly. Section 1028 of Dodd-Frank Act, it gives the CFPB the authority to restrict pre-dispute arbitration. We know that under Director Cordray, they're in the process of finalizing a rule that's expected to be issued shortly after the first of the year 2017. Well, the Act gives the CFPB the authority to consider restrictions. It doesn't compel such restrictions. And so a different director might use that same grant of authority to consider further consumer protections and decide that they're unnecessary.
I guess the other part of Dodd-Frank that we should talk about, sort of intertwined with all of this, is the swaps rules. What a lot of people don't realize is swaps received a very august position in our legal system as a result of Gramm-Leach-Bliley and some other amendments to the bankruptcy code where a swap had preferred position above even secured creditors under certain circumstances. And as a result, we saw a proliferation of swap contracts of all sorts, most of them bespoke, all of them extremely effective transferers of risk as well as wealth. And what we did see in the crisis in 2008 were bruising fights over collateral. Who held the collateral, who was entitled to the collateral, under what circumstances was collateral supposed to be paid. What Dodd-Frank did was mandate, first of all, a division between securities-based swaps that were based on a single security and all other swaps. Securities-based swaps are under the jurisdiction of the SEC. All other swaps are under the jurisdiction of the CFTC. So that's an empowerment of the CFTC that we had never seen in history. CFTC stands, of course, for the Commodity Future Trading Commission. As a result of that empowerment, as well as some other legislative provisions, we saw the creation of swaps exchange facilities and the mandated trading, if you will, of most swaps through the swaps exchange facilities. Well, why did they do that? Well, one of the issues, again, with swaps was you didn't know who the counterparty was because of novations and daisy chain offsets. You didn't know where the collateral was, and you always had counterparty risk, so therefore you were constantly demanding collateral because you didn't know if the other party on the swap would actually perform. By interposing an exchange, you're almost guaranteeing that the counterparty will perform, number one. Number two, by using an exchange, you're standardizing terms and conditions. And number three, by forcing both parties to state where their assets are that are being used to fund the swaps, you're virtually guaranteeing that there will be performance. And then another rule was that you had nonprofits and governmental agencies and pension plans needed to demonstrate that they had the competence, the economic competence and the legal competence in order to enter into a swap contract, because there were so many instances where municipalities were entering into swap contracts as investments and they had no idea what risk they were taking, what collateral they were putting on the table, and more importantly, how much it would cost them to get out of the swap contract in the event that the economics moved against them. I don't think you are going to see erosion of those rules anytime soon. The industry has sort of gotten used to how to deal with them, and you do have some semblance of order now in the swaps market that you didn't have. And the rules certainly haven't trimmed the appetite for swaps, because their numbers are as high as they were pre-meltdown. So I think that part of Dodd Frank is probably not going to be changed, except to the extent that the Volcker rule is modified and therefore allows the large brokerage houses and banks possibly to come in as counterparties.
Mark, I want to go back to the CFPB. Of the potential changes to the Bureau that may take place during Trump's presidency, what do you believe is the most likely to happen and why?
So I think the most likely to happen is that we see a new director and that we see a new director shortly into the administration. As has already been discussed, President Trump will have the ability to replace Director Cordray. And if Director Cordray wished to stay in that job, he really does not have that choice. And there's been a lot of talk about a lot of industry interest in having the CFPB change its structure from a single director to a commission. I think that may happen. I think that some of the support for that move may erode, given the enormous discretion and power that the director of the CFPB wields, and the same discretion that folks in the financial industry thought were abused by Director Cordray. They may feel otherwise when that discretion is in the hands of his or his replacement. So I think that a commission, while it is certainly a strong possibility, I don't know that one is as certain as some folks may believe it to be. Again, because if a new director begins to act in a manner very favorable to the industry would probably want that to continue for a time. So a commission may happen perhaps further down the road, but I don't think that that's going to be something that we would see immediately.
So is a restructuring of the CFPB necessary in order for the financial services industry to see significant changes from what the industry has experienced to date from the agency?
No, again, because the director wields so much discretionary authority. We've seen that, for example, with respect to the way that the CFPB has approached the abusive standard of UDAP, unfair, deceptive, or abusive acts or practices. It's in Section 1031 of the Dodd Frank Act. Rather than issuing regulations that would, fence in what that term means, the CFPB has approached it from the standpoint of we know it when we see it. A new director may not see it unless it's directly in front of their face. So similarly, you've got sections of Dodd Frank Act like Section 1028, which provides the CFPB authority to impose restrictions on pre-dispute arbitration, yet it's a discretionary authority. And so a new director could decide in that case that the rules that are pending, which will have an enormous financial impact on the industry if they go into effect, are either unnecessary or misplaced in their current form. So bottom line is you could have tremendous change seen from the CFPB simply by replacing the director and not fundamentally changing the structure of that agency in any way.
Rick, let's turn back to you. The CFPB has a number of controversial rulemaking in progress relating to small dollar loans, arbitration, collections, and prepaid cards. What do you think will happen to them?
Well, as Mark said, the director, whoever it will be, does have tremendous amount of authority, even if there are no changes to the CFPB. Although I have no doubt in my mind that the House, which has already passed the Choice Act, which would require the CFPB budget to be subject to the appropriations process, that there would be a board of, let's say, five members on a representative basis based upon political balance to be put in place, which I think many view as just the right way that an agency should be structured, so that even if you have a Republican, let's say, who is the director, many think that the Bureau could be run, in a much better manner, with that kind of structure. That being said, you do have some very controversial, rules which are currently pending. I mean, the small dollar rule, which the Bureau put out last June, and comment period finished up in, I think it was in September or October, I guess it was extended to, and there were, I think, 1.5 million comments that were provided on that rule alone. So there's no way, in my mind, that the Bureau, could finalize that rule anytime soon, and so you could see, that rule be shelved by the new director. That they could say that they needed to have more study being done of the rule, because, or the whole concept, based upon the comments, the voluminous number of comments that were made. And so I just don't think that rule is going to see the light of day. And the same thing with the arbitration rule. That is a very controversial rule. It would eliminate the ability of financial services companies to be able to compel arbitration and to eliminate the possibility of class actions. That to me is a huge issue for the financial services industry, and it is possible that, because that rule is relatively straightforward, and you could certainly see the Bureau try to finalize that rule sometime between now and January 20th. Now, if any of these rules are finalized, there's also something called the Congressional Review Act, which was passed in 1996 as part of the SBREFA legislation, which, if you have followed how the CFPB makes rules, you certainly are familiar with how SBREFA works. But this Congressional Review Act was passed as part of that, and it allows the Congress to reject rules that an agency would promulgate, within 60 days of them being finalized. And so you could certainly see both houses of Congress, pass legislation to reject any rules, and that rule, by the way, is not subject to filibuster. So it would be just a majority vote on in each house, and I could see that happening if the Bureau wanted to accelerate that rule. But I think any rules that are pending or that are finalized or will be finalized between now and the inauguration, I don't think you're going to see the light of day. And I think that is a huge win for the financial services industry, because either of those rules would have imposed increased costs on certain industries that are affected by that, and in some cases, basically put the high-cost lending industry pretty much out of business, even based upon some of the studies that CFPB has done. So good news in my mind for the industry on both those fronts.
I'll add one thought to what Rick just said, in particular to the cost of these rules. So one of the outcomes of the PHH mortgage decision is that, assuming that the director of the CFPB is now subject to presidential oversight, and that the agency is subject to greater oversight by the executive branch. Well, one outcome of that is that the regulations issued by the CFPB would now be subject to executive orders, including the Executive Order 12866, which requires cost-benefit analysis to be performed in connection with any rule. Now, the CFPB has, when you look at some of the proposed rulemakings, well, they've gone down that path, a bit, but someone could argue that now that the executive order applies, that analysis was not sufficiently robust, did not fully take into account all of the costs that might be imposed on the industry. So that's just another avenue through which some of these rules that are pending might be subject to, being revisited.
Rick, the CFPB has been very active in the enforcement area and has been criticized as regulating by enforcement. Do you see that continuing?
I really don't. I think that the Bureau really needs to rethink how it approaches regulation, and that doing it on the basis of issuing CIDs, which is a whole other subject that really needs to be remedied because of the tremendous burden that it places on companies that receive them and the very low threshold that the CFPB has to meet to issue them. But that's a whole other discussion. But I think that what you have seen is the CFPB has taken on individual companies, have really spent millions of dollars investigating them, and come up with consent decrees because the companies have decided that it's cheaper to agree to a civil money penalty than to fight the CFPB in court. So I think you're going to see a reduction in that approach, and hopefully a return to the idea of issuing regulations that there would be ability of notice and comment, so that there would be a opportunity for the industry, to weigh in on what the consequences and costs are of various regulatory proposals that they may put forth, and not do it on the basis of selective consent decrees, which Director Corddry himself has said that you're committing compliance malpractice if you're not complying with the teachings of these consent decrees. And the consent decrees are not subject to notice and comment, and so it really is not a very good way to legislate conduct in my mind. So I think that's going to be a big change in terms of how you see the CFPB operating in the future.
Greg, do you see a repatriation of offshore money coming?
President-elect Trump during the campaign said that he was going to make it a point to repatriate dollars that U.S. companies had earned but were quote-unquote stashing abroad, avoiding U.S. tax. So let's deconstruct that proposition a little bit. First of all, where is the cash? Is the cash really stuffed abroad, or is it actually in U.S. banks or branches of U.S. banks? A study done by the Wall Street Journal a few months ago actually found that most of these dollars that are allegedly abroad are sitting in U.S. bank accounts. Now, they're titled in the names of the foreign subsidiaries, but they are actually here. So what does that mean? If you repatriate the dollars, it means there's a tax due, but it doesn't mean that the economic effect, the investment effect, if you will, of those dollars is going to change because they're already here. And if they're in the banks, that means the banks have to deploy them in some way in order to earn a return. If they're not earning a return, then obviously the banks don't want the dollar. So I think in terms of will the repatriation itself improve U.S. infrastructure or investment? Probably not. But it will potentially raise tax revenue. So you have to understand how it was possible to avoid the tax in the first place. And most of these are transfer pricing type cases. A product is manufactured overseas. Let's call it a widget. The widget costs 25 cents to make. So the offshore manufacturer creates the 25-cent widget, sells the title of it while it's still on the ship heading toward the shores of the United States to some offshore intermediary company. that intermediary company takes title to the asset and then sells it to the American distributor for $25. So cost 25 cents, price to the U.S. distributor $25, and then it's sold in the retail market for 35, 45, whatever the market will bear. But the difference between the 25 cents and the $25 has been captured by an entity abroad, and those are the dollars that we're talking about here and trying to repatriate them. The IRS has tried for years through transfer pricing studies and otherwise to try to capture those dollars, but it's very difficult to prove. It's all very fact intensive, and so the administration is looking for a way. So a couple of theories that have been bandied about and ideas. One would be you use those dollars for Build America bonds. One of the big themes of the Trump campaign, again, was infrastructure. We need to rebuild our roads, bridges, etc. So you sell Build America bonds. Only people who could buy it are offshore dollars from U.S. companies, and you give them a tax break. Say, as long as the bonds remain outstanding and aren't sold for 15 years, then the money is essentially repatriated back into the U.S. without tax. That's a very easy and effective way to repatriate the money for a useful purpose today. If you use this to build a bridge, you don't have to raise taxes. So the net effect is I've essentially taxed that money, and if you allow it to, or if you force it to stay in solution in the bonds until such time as the bonds are repaid, well, then effectively the tax is the low interest rate that they earn, and you can do a present value computation to see if it's cheaper to repatriate the dollars or buy a Build America bond. I mean, that's one proposal that we've heard. The other proposals are much more blunt instruments. If you have, subsidiaries, finance subsidiaries, etc., abroad, and those dollars haven't been taxed in the U.S., we would simply impose a look-through rule that would force those dollars to come back. Well, as soon as you try to enforce the look-through rule, then what you're going to see is companies attempting to immediately invert, to move their corporate offices offshore in order to avoid that tax. Well, everyone has been attacking the inversion transactions. The IRS came out with a rule that says they're illegal. Whether or not that rule will ultimately be sustained by the courts is a different question. But everyone hates inversions because they are viewed as a perversion of the U.S. tax system. If you are going to attempt to force repatriation of dollars, you also, at the same time, need to put in some mechanism to prevent inversions. And probably the most effective one for that would be a return to a rule that used to be in place when I was initially coming in as a young lawyer, and that's the old 1491, 1492 excise taxes. It used to be if you tried to expatriate appreciated assets, there was a 35% excise tax imposed by the U.S. Congress. You could take the money out, they didn't care, but on the way out the door you had to pay an excise tax on the untaxed gains. And that was repealed as part of the Reagan Revolution in the early 80s, but maybe we need to relook at that, reinstitute it as a way of preventing the exportation of assets, because there can be an unintended consequence. If you try to force people to bring money back and they don't want to, then they may just move the company or dissolve the company or reincorporate elsewhere. And so you need to prevent the adverse consequence of your activity that you select. So will there be repatriation in some form? I believe there will be. The question is, what price are they going to extract? I think a blunt instrument approach is going to have a hard time getting through Congress, but something more creative, like I described in the Build America bond approach, that may actually work.
Mark, how is Donald Trump's presidency likely to affect the fintech industry?
It's a great question, and I think it could be a mixed bag, and here's why. So we've discussed the fact that on the consumer protection front, well, the industry may see some relief in terms of how laws, regulations are interpreted. So, for example, I've already spoken about UDAP, unfair, deceptive acts or practices. Obviously, when you're dealing with somebody online, there's a UDAP risk, And if there is, a more favorable approach to how UDAP's interpreted, well, that might benefit the industry. Even more significantly, we know that the fintech industry makes a lot of use of big data, alternatives to traditional credit report information. And, the CFPB, for example, has taken a very strong stance on, potential disparate impact. And so if you saw any, change favorable to the industry on how, things like disparate impact are interpreted, well, that might benefit the industry. On the other hand, the reason I say it's a mixed bag is that there's also a strong possibility of more regulation. So, for example, for a long time, the industry has actually asked for that regulation to provide certainty around things like federal preemption and interest rate exportation. But with more regulation comes further barriers to entry. You'd have a loss of flexibility and higher cost of operation. So although things like the OCC potential fintech charter that may be coming shortly may be initially welcome, additional regulation as this industry matures might also have the impact of quelling some of the innovative practices and that ease of entry into the market that have made the industry what it is now.
Okay, I've had you gentlemen over an hour now. Let's wrap it up with two more questions. I appreciate your time. Rick, any thoughts about the FTC and its role in consumer protection?
As I mentioned, the FTC is going to get new commissioners and a new chairman. I think you're going to see them continue to operate in certain areas, but there's always this tension, if you will, I think, between what the FTC does and what the CFPB does. The FTC has been around a very, very long time, and they do not have the same powers, certainly, that the CFPB does. And even though there is this memorandum of understanding between them, I always get the impression that the FTC is sort of the stepchild in the relationship. But whether there would be any changes in overall structure in terms of trying to absorb, let's say, the CFPB back into the various prudential banking agencies. That idea has been floated. As somebody said, there's only been one agency, I think, that's ever in the last, maybe in the history of our country, that's ever been abolished, and it had to do with something relating to tea. So I don't think you're going to see the FTC be abolished or the CFPB abolished. The FTC has carved out certain areas, that are within its expertise. It cannot regulate or go do anything with respect to the banking industry, but there's obviously the fintech industry out there, unregulated lenders that are operating, and so I think you're going to see them continue to focus on those activities. They focus on fraud and fraudulent conduct. I think that would continue. Focused on privacy, lead generators, fintech, online issues in general, and as I said, privacy. So I think you're going to see them continue to operate in those areas. But again, I think you're going to see a much more pragmatic approach, a business-like approach to regulation, and that they're going to go after the bad guys, which is what they should do, and not impose burdensome regulations on business that are going to make them less efficient.
It's Mark Dabertin. I'll add just a couple points to what Rick just said. So one of the areas where we see that the FTC active and where they wield a lot of authority is for non-bank financial entities. The CFPB enforces the data protections under the Gramm-Leach-Bliley Act. So for those fintech firms and other firms that are not banks, then the FTC would be a very important potential regulator in the area of data security. In addition, one of the reasons that the FTC no longer wields the influence that they used to have in the banking arena is that the Dodd Frank Act transferred the authority to interpret 14 different consumer protection laws over to the CFPB. Most notably, the FTC historically had a very significant role in interpreting the Fair Credit Reporting Act, and now they're really out of that picture. So although they may still enforce, they no longer have the same authority to interpret. And as Rick stated, unless you were to fundamentally change the relationship between the CFPB and the FTC, that wouldn't, you would expect no change in that regard going forward.
So I wanted to finish up our podcast on that theme of consumer protection with a simple question for Rick. Rick, is consumer protection dead under a Trump administration?
I don't think so. If you look at who his constituencies are, they include a lot of working class people that in many cases have been forgotten. At least they feel like they've been forgotten, and so they are going to be, I think, a focus of this administration. And part of that is making sure that consumer products are being offered in a way that's in accordance with law, and that they have the right disclosures that are provided to them, and that they understand the kind of products that they're getting involved with. So, one of the things that you always worry about, I think, if you're a Republican administration, is that you are viewed as being, in bed with big business. And so, many cases, Republican administrations have gone out of their way to show that they are not in bed with big business, that they're going to go after businesses when they make mistakes. And I think the timing of the Wells Fargo problem, in terms of their cross-selling scandal, if you will, I think was very unfortunate, because there was a lot of discussion about trying to abolish the CFPB as a result of that. But here is a major bank, one of the largest banks in the country, that were making things up or their employees were making things up because of their compensation structure. And whether you could argue whether or not consumers were actually hurt by any of this, because I'm not sure that there is a demonstrable evidence that they were. But it just shows that there is misconduct in the marketplace by regulated institutions. And the CFPB kind of got into that whole investigation at the last minute. It was actually the investigation that was started by the district attorney in Los Angeles, I think. But the CFPB got involved and got a lot of credit for it. So I think that really kind of saved their bacon, if you will, in terms of sort of thwarting efforts to try to abolish them, because Wells Fargo was the target of criticism by both Republicans and Democrats. And so I think that that is evidence that you do need a regulatory structure, you do need consumer protection statutes, and so I think that will continue, although I think it will be a different focus under this administration and not as aggressive or pushing the boundaries, if you will, as the CFPB has done on some of their theories of liability.
I'll add one point. Laws like the CARD Act are on the books, and they're not going away. And so there's no way that no matter who's in the role of, say, director of CFPB, that they're going to be able to ignore, violations of those laws that are already there. And they may be able to interpret certain gray areas differently, but many of those restrictions, for example, in CARD Act, are pretty black and white, and those I do not believe are going anywhere and will continue to be enforced.
So that's all the time we have for today. Gentlemen, thanks for all the time you spent going into detail on these questions. For our listeners, please be sure to be on the lookout for future podcasts on this topic as the year goes along.